Hi, Tony Carrion with you. In the most recent Elliott Wave Theorist, the monthly publication of Elliott Wave International's founder, Robert Prechter, he draws a strong distinction between forecasting based on linear extrapolation, that is, projecting current trends into the future, and what he defines as fractal extrapolation. As he notes in his article, most futurists, including financial speculators and economists, extrapolate trends in markets and the economy in linear fashion. Wall Street's corporate analysts, many of whom are trained economists, are notorious at this practice. They review the data from the recent past and, quote, predict that the trend in effect will continue. Since herding creates both trends and reversals, linear extrapolation of a financial market is doomed to be exquisitely wrong when it matters the most, at the cusp of major trends. When you're a linear forecaster, you can't detect any turns. Bob goes on to add, to explain and predict social and financial change, socioeconomic theory rejects the paradigm of linear progression and replaces it with fractal progression. The Elliott Wave model has an 80-year history of useful application. By its very nature, it incorporates both trends and trend changes at all wave degrees. That's not extrapolating a straight line. That's looking around the corner. We'll see now how we applied this concept, that of seeing around the corner, in our analysis of Bitcoin's recent price action. As Bob notes, fractal extrapolation requires a knowledge of the wave forms identified by the Elliott Wave principle, and how they coalesce to make actual prediction possible. We had initially considered Bitcoin's bear market could have ended at its 17,614 low of June, but as more of the recovery unfolded, it was increasingly looking like a corrective rally. This is why a knowledge of the waveforms is critical, in that it prevented us from jumping to the conclusion that Bitcoin was headed yet higher, and not that it was launching a 36% decline. As this chart suggests, we formally turned bearish Bitcoin in the Cryptocurrency Pro service, anticipating the probability of further lows beneath 17,614. One of the factors in our decision making was that the decline from Bitcoin's recovery high of 25,198 of August 15th was looking more impulsive than the rally that preceded it. Here we see a developing five-wave pattern. As the wave principle informs us, five waves move in the direction of the one larger trend. In this case, it was suggesting Bitcoin should be headed lower. Now, there was a temporary pause in the decline that lasted until early September, which we identified as a triangle. Another corrective pattern that implied further lows still ahead. By September 7th, Bitcoin retraced nearly all of the rally from 17,614, reaching an intraday low of 18,598. That low produced a 22% rally that ended on September 13th, from which Bitcoin has plummeted more than 12% at this juncture. In consideration of our paid subscribers, the labels have been left off. Now, some may interpret that 22% rally as a bullish sign, though it isn't necessarily. Our subscribers know how we are interpreting the fractal patterns and where we see Bitcoin headed next. Thanks for watching.